Regulation of interest rate. So the Reserve Bank is authorized to regulate the interest rate based on the section 21 and section 35A of the Banking Regulation Act. So how RBI regulate? Basically there is provision in the Banking Regulation Act under section 21 and and 35A to regulate the interest rate in the banking. This includes the rate of interest for loans and the advances as well as the deposit. It obviously the rate of lending as well as the rate of deposit, that is the deposit and the advances for both. RBI can regulate the rate of interest. While giving the direction on the interest rate, there should not be any discrimination against any class of depositor or loan to the bank. So obviously the RBI ensure that there should not be any discrimination when we are lending money, right? So that is what the proper care has been taken by the RBI. Now see, first the interest rate on deposit, how RBI regulates. The rate of interest on the deposit were not regulated by the Reserve Bank of India until 1964. That means until 64 it was very much open. Hence it was very much open to the bank to decide their deposit rate freely until 1964. So it is important to note that until 1964 individual bank were free to decide the rate of interest. Thereafter the Reserve Bank has been issuing the direction to regulate the interest rate of the deposit whenever it is applicable. So after 1964 RBI started regulating the interest rate on the deposits. Accordingly, the payment of interest on the current account was prohibited. That means accordingly after 1964 the RBI has guided that there should be no interest should be given on any current account balance. Okay, so we can conclude from that pre 1964 there was the interest on the current account. After RBI has prohibited that. Now the Reserve Bank issued the direction under section 35A of the Banking Regulation Act, and the bank must satisfy that the direction are necessary for the public interest, for the interest of depositor and for the banking policy. So obviously now under section 35A RBI can regulate the interest rate on the deposits. Okay, so only thing you remember after only the 1964 that is since 1965 we can say RBI started regulating the interest on the deposits. Now the Reserve Bank may permit the higher rate of interest for certain category of a depositor like employees, right? We are getting 0.5% extra, right? For cooperative bank deposit we are giving some higher rate of interest. So that is what the RBI permits. Now bank can decide the rate of interest. So now it is very much liberal, right? RBI has deregulated the interest on the deposits. So here how that RBI deregulated, how the bank can decide. So deregulation of the interest rate on the deposit. At a present scheduled commercial bank like ICICI, HDFC, apart from that the nationalized bank like SBI, Bank of Baroda, these are the scheduled commercial bank which are included in the second schedule of RBI. So at a present the scheduled commercial bank and the small finance bank, these are allowed to offer the differential rate of interest. Differential means they are having some leverage. Okay, and these are for on term deposits, right? On the basis of the tenure, on the basis of the quantum, obviously for a single term deposit of rupees 2 crore and above. So you can check out in your notification whenever the term deposit which is more than 2 crore and it is in a single term deposit, the bank can offer the differential rate of interest. That means the customer can bargain with the bank that you provide that much of interest, I demand higher rate of interest. Okay, so that is possible as per because RBI has deregulated the rate of interest. Okay, remember only the scheduled commercial bank and the small finance bank, these can offer only for the single term deposit having amount more than 2 crore a differential rate of interest, means which can be decided at their level. RBI are allowed to offer the some differential rate for term deposit, the RRB. Now it is only for scheduled commercial bank and the small finance bank. Now RRBs for also they are having some leverage. The regional rural bank, for them they are having more leverage. Starting with 15 lakh plus they can decide the rate of interest. Okay, so for RRB the 15 lakh plus they will have the differential rate of interest. Okay, now interest rate on the loan and the advances. See, the interest rate on the loan and advances is subject to regulation specifically under section 21(2)(e) of the Banking Regulation Act, apart from the general provision as per the section 35A. So we have discussed, right? Section 35A regulate the interest rate on mainly advances. If we see a particular section, we have to see the section 21(2)(e) of the Banking Regulation Act, which is specifically for the loans and advances interest rate. Now, freedom is given to the bank to decide the rate themselves. Currently, this direction of RBI regarding the interest rate of the advance cover only the finance to the weaker section, exporter, and certain small loan and the DRI loan. So obviously RBI now has been deregulated the rate of interest at which the bank should give the loan, right? So currently only a loan to the weaker section, loan to the exporters, or some certain loan like a small loan, like we are providing the Pradhan Mantri Kaushalya Yojana for that, right? Pradhan Mantri Swanidhi Yojana. So for that, these are what? These are for that only RBI is stipulating the rate of interest. Otherwise, apart from that, some DRI loans are there. So the DRI is differential rate of interest scheme. So for such a scheme only RBI is regulating the rate of interest. Rest bank can decide themselves. Now we have to see the different rate in which the in the banking system has been used. First, there was only the BPLR. BPLR stands for the benchmark prime lending rate. So basically, the BPLR system was introduced in 2003 with the objective to bring a transparency in the lending rate, right? This was mainly the objective under the BPLR system. Now the bank could lend below the BPLR. So how that why basically this system was rejected? See, BPLR means the benchmark prime lending rate. Suppose the benchmark prime lending rate is 12%, right? So what happened for the prime customer, for the good customer, the banks started offering the rate say 10%, say 11%, right? So this was the below the prime lending rate. So RBI think there is no transparency. There is a benchmark rate of 12%. Still the bank are able to lend below that. So it is a good for the customer, but not having transparency, right? So that's why as banks can lend below the BPLR, RBI has said that we have to bring the new system, and that's why the base rate system came into picture. So base rate system has been aimed at enhancing the transparency in a lending rate for the banks and enabling the better assessment of a transmission of a monetary policy. So accordingly, the following guidelines were issued. So what are the guidelines for the base rate system? So see, base rate system is replaced with the BPLR system, right? So the benchmark prime lending rate was replaced by the base rate, which was mainly effective from 1st July 2010. Okay, so when the base rate came into picture, it came into picture July 1st 2010. The bank may determine their actual lending rate on loan and advance with reference to the base rate. So what do you mean by it? So for example, see, you are having, suppose the bank has a base rate say 8%, right? So based on that means what? Below which bank cannot lend the money, and bank has to decide the rate of lending to any loan. They have to add some percentage, it may be the spread or any cost, right? So say 9% bank can offer the loan. So base rate is 8, below that bank will not going to lend, right? That is what the base, right? So simply below the base rate, bank are not allowed to give the loan. So base rate system is governed by the average cost of fund. Okay, so whatever the cost bank is incurred for getting deposit, paying the interest, spread, margin, extra operational cost, that all average has been taken into account, and based on that the base rate is being calculated. So it is average based. Bank cannot sanction the loan below the base rate, right? Only some exceptions are there. For example, some stamp loans are there, or you are giving loan against the fixed deposit receipt of your own bank, then only you can have the exception. Otherwise you cannot have the loan to sanction below base rate. See, these systems are now absolute. These are not useful because we are using the MCLR. That also just we have to look into the history how the banking rate has been evolved. Okay, now only one, this is what simply base rate was came into picture, and it implies the only single rate for all maturity. So there was only one base rate for all maturity, right? The base rate reviewed once in the quarter by the ALCO committee of the bank. ALCO means asset liability committee, that are supposed to review the base rate only in the once in the quarter, right? So RBI has replaced the base rate by the MCLR starting from 1st April 2016, right? So it was very much improved step to replace the base rate with the MCLR. Why? Because MCLR is considering the rate which is same for all maturity, so it was very much risky. Apart from that, the base rate only reviewed once in the quarter by the asset liability committee, which was also again the risky. That's why the base rate was basically replaced with the MCLR rate. Again, it consider the average cost, which is also again the risky, because we have to consider the current cost, right? Then only we can get the accurate measurement for the rate of lending. So RBI has replaced the base rate by MCLR. So initially the benchmark prime lending rate replaced with the base rate, then base rate replaced with the MCLR, which currently we are using. Okay, now the base rate started since 1st April 2016. Okay, now let's discuss in detail. MCLR stands for the marginal cost of fund based lending rate. So the base rate interest system was replaced by MCLR to determine the lending rate for the commercial bank with effect from 1st April 2016. The MCLR is improved version of the base rate. Simply it is improved version of the base rate. How? See, MCLR is determined by current cost of fund, whereas the base rate was determined using the average cost of fund, right? So the bank cannot quote the rate below its MCLR. So obviously, as the same thing, below base rate you could not lend. Similarly, below the MCLR you cannot give the loan. Only some exceptional, like a loan against the deposit or to the staff or to the DRI scheme. Now MCLR rate, interest rate should be reviewed once in the month. It is mandatory, right? So it is giving more accuracy, more cost adjustment for the bank. So MCLR is reviewed once in the month by the ALCO committee, that is the asset liability committee of the bank, and bank has to give at least 5 MCLR. There must have some, every bank has to give the 5 MCLR. First is the overnight MCLR, second is the 1 month MCLR, third is 3 month, fourth is 6 month, and fifth is the 1 year. Okay, so and bank can have more. If bank have to give more MCLR, they can quote, no problem, but that is mandatory as per the RBI that minimum 5 MCLR has to be disclosed by the bank. Overnight MCLR for 1 month, for 3 month, for 6 month, and for 1 year. Very simple, right? So that also you have to remember. Apart from that, 5 MCLR, remember, overnight MCLR 1 month, 2 month, 3 month, and 12 month. Okay, now resetting 1 year, the resetting of 1 year and above MCLR shall be done only once in a year, right? So if you have to reset the MCLR for 1 year and more than 1 year maturity, then you can do it only for the once in a year. Okay, otherwise rest you can do. For rest there is no any criteria, but the maturity period more than 1 year or 1 year, you can do only resetting of the MCLR only in once year. Okay, and there are 5 MCLR, overnight, 1 month, 3 months, 6 months, and 12 months. Okay, that is important for exam point of view also. Now let's talk about the component of MCLR. What components are basically considered while deciding the MCLR? Very simple. Now see, the marginal cost of fund. What do you mean by simply the needed to disburse that marginal loan? What is the marginal cost? It is the cost which is required to disburse the marginal loan. Means what? It take into account the repo rate. Repo means repo rate. Apart from that, the rate of return which the bank has done on the investment, rate of return which bank is getting on the investment done by the bank. Okay, so very simple. Marginal cost of fund means simply which is needed to disburse that marginal loan, right? Then again, operational cost means simply the cost which is incurred for disbursement of that loan. Negative carry on CRR. So what is negative carry? See, as bank are not getting any interest on the CRR, but still bank has to pay some cost for the fund which are having with the bank and kept as a CRR. For example, bank has kept the fund as a CRR, for example 400 crores, right? So bank will not get any interest on the CRR, but when the bank get that money from the public, but bank has to pay some interest on that to the public, right? That means the fund kept with this in the CRR, bank has to pay some cost. That is what the negative CRR. That is the negative carry on the CRR. Now how it is being calculated? Simply the required CRR, what is this required CRR, divided with the marginal cost and multiply with 1 minus CRR, then you will get the negative carry on the CRR. Okay, now simply the 10-year premium means what? 10-year premium means what? Simply depending on the period of the loan which is decided. So what is the 10-year premium? So obviously what is your loan period? Depending on the period of the loan, the 10-year premium will be decided. Generally, see, if the loan is having the long term or more than 1 year, more than 3 year, in such cases the rate of interest will be more, right? So if the tenure of the loan is less, the rate of interest will be less. That means what? It is the 10-year premium. Due to the 10-year, the cost is affecting, the rate is affecting. That's what is called as the 10-year premium. The change in the premium for a longer loan should be same for all type of loans given at the residual tenure. So simply, what are the component of the MCLR? The marginal cost of the fund, the operating cost, negative carry on the CRR, and the 10-year premium. These are the 4 components for the CRR which are important, which you have to remember for exam point of view. Okay, the cost of fund, apart from that the operating cost, then the negative CRR and the 10-year premium. Okay, these 4 you have to remember. Okay, now see what is difference between the MCLR and base rate. Why we switched from base rate to MCLR? Simply MCLR was considering the current cost of fund, whereas the base rate is considering the average cost of fund. MCLR is calculated by the 10-year premium. So 10-year premium we are considering, right? But in case of base rate, only the minimum profit margin or the rate of return is considered for calculation of the base rate. Again, the MCLR take into account the repo rate, whereas base rate was not taken into account the repo rate. Repo rate is the rate at which the bank can get money from the RBI. MCLR is determined by the considering deposit rate and the repo rate along with the operating cost and the cost of CRR. That is what the 4 factor which determine the cost, which determine the MCLR. The base rate is only governed by the operating expenses and the expenses for the CRR. It does not consider the repo rate. Okay, these are some difference between the MCLR and the base rate. Now external benchmarked based lending. So what do you mean by it? Simply see, EBLR is what? External benchmark based lending, where the lending rate set by the bank based on the external benchmark. Simply name itself is indicating there will be some external benchmark, not only the internal. In MCLR we are considering only internal benchmark. Then after that RBI has evolved with some external benchmark, right? So if you are considering that benchmark, that means you are lending with the external benchmark based lending. Okay, what are the external benchmark? For example, repo. So who decide the repo? RBI decide externally. Then T-bill rate for 91 days, then T-bill for 182 days. Right? These are the external benchmark. Based on that, bank decide the rate of interest of the lending to the customers. That is what? That is the external benchmark based lending. Okay. Now every bank can choose any such external benchmark and link its lending rate. What can be it? See, this is started since 1st October 2019. Okay, so it is applicable for all new floating rate retail loan and the SME segments. So generally all floating rate are linked, all loans having the floating rate of interest, these are linked to the external benchmark based lending. Okay, now MCLR system is also continue. Only in addition to that we are having the external benchmark based lending. Okay, and these are mainly with the floating rate system. Okay, the bank can convert other segment into the EBLR system. That's liberty is given to the bank that you can convert the existing segment into the external benchmark lending rate. Existing customer under the MCLR also can switch to the EBLR if they are having that chances. The reset of interest rate under the external benchmark. How it can be done? Simply, at least once in a 3 months, you have to reset the rate of interest. How? So the customer will get the benefit immediately after reduction of the repo rate by the RBI. If RBI decrease the repo rate, the rate to the customer will again decrease. If RBI increase the repo rate, then rate to the customer will increase. This is simply the external linking, external benchmark based lending. the multiple benchmark by the bank within the same category and lending below the EBLR is not permitted. Obviously, within the same category, if you have multiple benchmark and out of that you are choosing only one which is lowest, which is not allowed. Okay, for example, you are having benchmark. For example, you are considering the benchmark as a repo rate, the T bill for 91 days, the T bill for 191 means say 3 months, T 182 means say the 6 month. Okay, so which is lower, this, so this you will consider for lending. So this is not allowed, right? So multiple benchmark you cannot decide for the same category and lending below the EBLR. Okay, this is common sense. Apart from that, how the spread is being decided on the external benchmark. See, the bank are free to decide the spread over the external benchmark, right? So further, what do you mean by spread? See, for example, external, for example, there is a repo, right? Is your what? Is your the, for example, say the benchmark. Repo is suppose 9%, right? So on that you can add spread, for example, 3%. It is your own cost, right? So you can lend money at a 12%, right? This is what the 3% is, what the spread. So bank has bank are free to decide their spread. Further, other component of the spread, for example, operating cost, right? That can be that could alter the only once in 3 years. See, spread you can decide. Remember, the spread bank can decide, but there are some component of the spread, right? Which you can alter only once in the 3 year. See, you have to decide the components there must be in the spread, and that component you can change only once in a 3 year, right? But spread you can decide, but components of the spread, see, spread you can decide, but whatever the components in that spread you can only change once in the 3 year. Also, you have to note that the interest rate on the fixed rate loan having the tenure less than 3 year shall not be the less than the benchmark rate for the same. Generally, it is very much common that the fixed rate is always more than your benchmark rate, right? And that's why the simple guideline is the same. Fixed rate should not be less than the benchmark rate. Benchmark what? The external benchmark rate, right? So it is very simple. It is always very much common that the fixed rate is always more than the floating rate, right? Floating means which is linked to the external benchmark. Okay, now what are the 4 external benchmark prescribed by the RBI? Again the same thing, repo rate, the RBI policy repo rate. If linked to repo, the interest rate shall be known as the repo linked interest rate, that is the RLLR. 3-month government T-bill. T-bills means the treasury bill. So it is published by FBIL. FBIL stands for the Financial Benchmark India Private Limited. 6-month government T-bill. T-bill means treasury bill yield. So it is FBIL, published by FBIL, Financial Benchmark India Private Limited, or any benchmark decided by the FBIL. Okay. So simply, what can be the 4 external benchmark that you can choose? Is simply the repo rate, is simply the 3 months T-bill yield, 6-month T-bill yield, or any other decided by FBIL. So FBIL is what? FBIL is basically promoted by the FIMDA, FEDI and IBA. IBA means Indian Banks Association, FEDI means the Foreign Exchange Dealer Association of India, and FIMDA means Fixed Income Money Market Derivative Association of India. Okay, so these are the 3 institutions basically which promotes the FBIL, Financial Benchmark India Private Limited. Okay, so these are just for your information. This is just for your information. Okay, again for the information, FBIL was formed based on the Vijay Bhaskar committee. That committee has recommended to RBI to have the FBIL, and then the FBIL is formed, promoted by the FIMDA, FEDI and IBA. Now see, one act, that is the Usurious Loan Act 1918, and in the beginning itself you have to note it is not applicable to the bank. Why? Because it is making some contravention. That's why section 21A was inserted into the Banking Regulation Act to remove the superseding of that act. Okay, so see in detail, the Usurious Loan Act 1918 is not applicable to the bank. That Usurious Loan Act 1918 prohibits the lending at exorbitant rate, and there is a stipulation that no bank should lend at exorbitant. So who can lend exorbitant? Obviously, the law was initially made to protect the weaker borrower from the powerful money lender. So who can be have charging higher rate of interest? Simply the private money lenders. They are charging the higher rate of interest, right, from the weaker borrowers. So section 21A was inserted into the Banking Regulation Act, and to make the rate of interest charged by the banking company beyond any scrutiny of the court. That means whatever rate of interest you are charging to the customer, nobody can challenge it in any court in India. So to charge the rate of interest by the banking company, it cannot be challenged in any court in India. This is possible only because of section 21A of the Banking Regulation Act. Okay, so it is having some superseded effect on the Usurious Loan Act 1918. So how we can get the protection on the interest rate? So section 21A of the Banking Regulation Act provide that the transaction between the banking company and its debtor, that is the person who taken the loan, cannot be reopened by any court on the ground that rate of interest charged is excessive. That is what the court cannot do any interference in the matter of interest rate between the bank and the customer. So this is what the protection we are getting under section 21A. The provision is given that having overriding effect over all the provision of Usurious Loan Act or any other act relating to the indebtedness in force in any state. So this is having overriding effect on any act, any law as per, and also on the Usurious Loan Act 1918. That's why we are getting protection. No customer can go to the court and say that the bank is charging me more rate of interest, because it is the agreement between bank and the borrower. Now, regulation of the payment system. See, RBI regulates the payment system in India. That we have to see detail in chapter 11. So now see some internet banking guideline of RBI. So the Reserve Bank of India has set up the working group on internal banking to examine the different aspect, right? So the what are the different aspects of the internal banking? For to analyze it, for that purpose the RBI has set up one working group, right, basically on the internet banking to examine the different aspect of the internet banking. That is simply called as the iBanking. Now see, in that group, group basically focused on three major area of the internet banking. Okay, so what are the guideline from that? We will see here that basically guideline cover the technology and the security issue, the legal issue, and the regulatory and the supervisory issue. Okay, now see here it is very easy to note about the internet banking, right? So the internal group of RBI framed some guideline. Okay, that guideline we will see. For technology and security issue, they are having some guideline based on the physical access control, testing of a backup data testing, business continuity plan. The message to be kept for record purpose both in encrypted and decrypted form. Information security officer and the information security auditor has to be there to conduct the periodic penetration of a set of the system, like using the password crack tool or overloading the system, then using the ethical hackers. So that what the basically guideline in the technology and the security issue. Then logical access control like a password and the user ID, then public key infrastructure and the security policy approved by the banks board, that should be there. These are what's only the recommended guideline. Okay, so you don't need to learn, you don't need to mug up. Okay, just go through it. What are the legal issues? See, in case of account opening request which is received over the internet banking, then proper identification should be there. This is the recommendation. Then adequate risk control measure should be there in case of legal, and the compensation policy to authorize the for the unauthorized transaction or the hacking. So if anybody uses your password, if hacking is happening, then how much compensation should be given by the bank to the customer. So these are some guidelines regarding to the legal issue. Apart from that, there are some regulatory and the supervisory issue. That are simply the RBI approval to start the internet banking service by the bank is required. Then breach of failure of a security system and procedure to be reported to the RBI. The interbank payment gateway provided only to the clearinghouse members. Then all interbank payment should be in a real time, and that should or it can be the intraday, that is on the same day. Connectivity between the interbank payment, that is between two different banks, there must be the gateway, and member bank has to go through the leased line network and not through the open internet. Only there must be the leased line network, and that also with the proper encryption. Now, view only facility in the internet banking. What is view only? Where no transaction or the fund transfer is permitted. Only you can view the statement, or you can submit any small request like a checkbook request like that. Okay, it is what, but you cannot do the transfer of fund. The cooperative bank have to report the commencement of the service of a view facility in the internet banking to the concerned regional office of the RBI. Also, NABARD, they have to report in case of the state cooperative bank or the district central cooperative bank. Okay, so if any cooperative bank starting the internet banking with only view facility, they have to report to RBI regional office, and they will report to NABARD if the bank is a state cooperative bank. They will report to the NABARD if the bank is district central cooperative bank, and that should be within 1 month of the operation. Now, transaction facility means what? You can do the transaction, view plus transaction. So in this, two-factor authentication is required, internal control should be there, proper security and technology standards should be there. This is what the guideline for the transaction and transaction plus view in the internet banking. For cooperative bank, they should ensure that the fulfilling the following criteria before launching the transaction facility in the internet banking. So they should have the CRAR not less than 10%, means more than 10%. Net worth should be 50 crore and more. The gross NPA should be less than 7%, and net NPA should not be more than 3%. Net profit for the cooperative bank in the immediate preceding financial year. Overall net profit at least 3 out of the preceding 4 financial year. That means the cooperative bank should be profitable. That is what net profit in the last financial year, and out of 4 in the preceding, 3 should be in the profit. Now, the cooperative bank should not have the defaulted in any maintaining the CRR SLR requirement in the preceding financial year, and they should have at least 2 professional director on their board, so that they can guide them, they can take care of the internet facility. The bank should have the track record of regulatory compliance, and no monetary penalty has been imposed in the history for a violation of the RBI guideline during the past 2 preceding financial years. Okay, this is what the criteria for if the cooperative bank want to start the internet banking with the transaction facility. Now, see, regulation of a money market instrument. So what are the money market instruments? See, commercial paper, right? Apart from that, the certificate of deposit. These are the money market instrument. See in detail section 45W of the RBI Act, which is inserted in 2006, gives power to RBI to regulate the transaction in the derivative money market instrument and to determine the policy on the interest rate product and give direction in this regard. So how the basically RBI regulate it? RBI regulate using section 45 of the RBI Act. What? The money market. How money market is regulated by RBI? Simply using section 45W of the RBI Act. Okay. Now, what is call money? Call money is a borrowing or lending of money for up to 1 day. It is called as call money for only 1 day. Notice money means simply money used or money lent for 2 days to 14 days. And term money means the money borrowing lending for more than 14 days is called as the term money. So very simple, right? Call money is only 1 day. Notice money means 2 to 14, and term money means beyond 14. Okay, this is very simple. You are already aware. Now, how the money market is being regulated? See, the RBI has permitted the following participant to participate in the call money, notice money, or term money in both or any, depending on the following borrower, as they can borrow money or they can lend money from the following market. Okay, so who can do that? See, in money market, who can lend, who can borrow? Simply the scheduled commercial bank, but out of that the local area banks are not allowed. The payment banks are allowed, small finance banks are allowed, and the regional rural banks are also allowed. The cooperative bank, in case of that, the state cooperative bank, district central cooperative bank, and the only urban cooperative banks are allowed. The primary dealer, obviously they are working in the money market, PD, primary dealers. Okay, so who can operate? Obviously the commercial bank, payment bank, small finance bank, and the RRB. Apart from that, the cooperative bank and the primary dealer. These are mainly 5 financial entities that can operate into the money market. Now, Trading can be undertaken over the counter or through NDS. NDS means negotiated dealing system, which is simply the electronic screen based system. So where you can trade that product. For example, say you are having CD, you can do it over the counter or using the NDS. Then borrowing or settlement is happening through the RTGS, and money market timing is 9 am to 5 am on business days. Okay, this is additional information. Now see in detail how that for exam point of view it is important. See, the prudential limit for outstanding borrowing transaction in call money, notice money and term money market. Okay, so see here. See who is the participant category. For example, for scheduled commercial bank, right? What is the prudential limit for it? Call money and notice money. So these are the scheduled commercial bank plus small finance bank. Okay, so scheduled commercial bank plus small finance bank. What is the criteria? See, 100% of the capital fund on daily average basis in a reporting fortnight, they can do the borrowing and lending in the call money and notice money. Means what? For one period or up to 14 days, up 1 day to 14 days, and 125% of the capital fund can or on any given day. This is what the criteria for call money and notice money to the small finance bank and the scheduled bank. Now what about term money? The internal board approved limit within the prudential limit for interbank liability can be given. So what so who decide basically for term money criteria? It can be decided by the internal board of that bank. Okay, so simply call and notice money 100% of the capital fund on daily average basis in reporting fortnight, or 125% of the capital fund on any given day. Okay, so this is what the provision for limit for scheduled commercial bank and the small finance bank. Now what about the payment bank and the rural bank? The payment bank and a regional rural bank, what is the criteria for them? Call, notice and term money, they are having limit 100% of the capital fund on daily average basis in reporting fortnight on, and 125% of the capital fund on any given day. They are having some that limit. For cooperative bank, what is limit? For call, notice and term money, they are having 2% of the aggregate deposit at the end of previous financial year. They can do the transaction. For example, in the previous financial year, they are having aggregate deposits, for example 300 crores. So only up to that 2% they can deal into the money market. So it will be what? It will be only up to 6 crore they can do the transaction in the money market in the form of call, notice or term. And so it is very easy to remember. Cooperative bank simply 2%, right? Now PD, for short period, that is call and notice money, they can have 225% of the NOF, net on fund. That is what? Obviously again the same at the end of previous financial year or on a daily average basis in the reporting fortnight. And for term money, again they are having 225% of the net on fund at the end of the previous financial year. So generally the criteria is same, 225% of the net on fund. Simply you can remember, that is more than enough. Okay, so this is what the prudential limit for outstanding the borrowing transaction. So how much you can borrow in the call, notice and term money market. So this is all about the borrowing transaction. Okay, so scheduled commercial bank and the small finance bank, 100% of the capital fund for the call money, notice money, 125% for of the capital fund for given day, and 100% for the average daily average in last 15 days. Term money decided by the bank. Then payment bank and the RRB, 100% of the capital fund daily average basis in last 15 days or 125% of the capital fund. Cooperative bank simply 2% and primary dealer simply 2 to 5%. Okay, so highest prime PD is having more authority because they are primary dealing in that daily basis, right? And their prime job is that. That's why they are giving more. They have given more leverage to 25% of net on fund. Okay. Now let's talk some more about the certificate of deposit. So what is certificate of deposit? See, certificate of deposit is what? It is a negotiable unsecured money market instrument which is issued by the bank in demat form. So who issue the certificate of deposit? The bank issue the certificate of deposit in the demat form. Demat means online, means not in the physical form, online, dematerialized form, and obviously against the fund which you are having in the bank. These are held at a depository registered with the SEBI. For example, depository may be like, for example, our share where it can be held with our broker. For example, I am having with the Zerodha, I am having with the Grow, So these are the depository, right? So these are depository brokers, they are registered with the SEBI. So obviously CD is what? It is negotiable, unsecured. It is not secured, remember, it is unsecured money market instrument. Now, and the depository with we are having our CD that has to submit that to the RBI fortnightly basis. Okay, the CD are issued as the usance promissory note. What do you mean by usance promissory note? Means what? It is simply the promissory note of payment. You are, yes, okay, we are going to pay. Usance means it is having some fixed date. It is having some fixed date or having some fixed period, right? For example, some maturity after 2 years, after 1 year, after 6 months. This is what the usance means, having some bound tenure. That is called the usance. It is simply the promissory note. It promises to pay. It promises to pay. Okay. RBI has permitted the following entity to issue the certificate of deposit. Who can issue? Simply the scheduled commercial bank can issue the certificate of deposit. The RRB can issue and the small finance bank issue. Only the scheduled commercial bank, the regional rural bank and the small finance bank, they can issue the certificate of deposit. The local area bank and the payment bank are not eligible to issue the certificate of deposit. What is the period of certificate of deposit? Minimum 7 days and maximum 1 year is the period for certificate of deposit. The selected all India financial institution can issue the certificate of deposit for a period more than 1 to 3 year. For period 1 to 3 year. Only for selected financial institution it is allowed. Okay. So general period is 7 days to 1 year. But some financial institution they are allowed. They can issue up to 3 year. 1 year to 3 year. Amount of CD. It is minimum 5 lakh and then multiple of 5 lakh. Who is the investor? Only the resident Indian can invest into the CD. So how the discount rate is there or the coupon rate is there? So CD can be issued at a discount to face value or at a floating rate also. What is discount to face value means what? See, I am having CD of say 10 lakh, but I am purchasing right now, for example, at 9 lakh rupees, right? That means after maturity I will get 10 lakh. This is written on the face of that paper. That is called face value. Okay, very simple. But I am getting a discounted price. Say today I am getting at 9 lakh, but after maturity I will get 10 lakh. That is what discount at the face value. Or it can be discounted at face value, or it can be at a fixed, or it can be at a floating, depending on the type of the CD. Okay, very easy. So what is important bit you should remember about the CD? It is issued by the bank. Only the scheduled commercial bank, RRB and the SFB are allowed. The local area bank, payment bank are not allowed. Period is 7 days to 1 year. Some financial institution can do up to 1 to 3 year. It should be in the 5 lakh and multiple of 5 lakh. These are the important bit you should remember. Now let's talk about the commercial paper CP. So commercial paper CP is also defined as it is again the money market instrument. It is having section 45W of the RBI Act. So the RBI regulate the commercial paper under section 45W of the RBI Act. It is again the money market instrument. Again it is unsecured money market instrument. It is issued again in the form of promissory note. And it is again in the issued at always issued as a discount. So why discount they are issuing? Obviously, see, once you got the paper, say commercial paper, written is there that 10 lakh rupees. So you will purchase today in discount, for example, say 9 lakh. So it simply is called as the issued at a discount. Now following are the eligible who can issue the CP. Who can issue the CP? See, CP for commercial paper. Any company want money, they can issue the commercial paper. They will get money, people will purchase that commercial paper. So the company or the NBFC or the all India financial institution, they can eligible to issue the commercial paper. Bank are not eligible to issue the commercial paper. So to alternative to the commercial certificate of deposit, there is the commercial paper. Got it? The other entity, for example, say cooperative society, any unions, trust or the LLP having a minimum net worth 100 crore, they can issue the commercial paper. Any other institution specified by the RBI, permitted by the RBI, these are also eligible for the commercial paper. Then condition. What is condition? Any fund based facility from the bank or the financial institution which is availed, which should be availed by the company which is going to issue the commercial paper, that should be under the standard category. That means what? The any company, NBFC or cooperative society, trust, any LLP which supposed to issue the commercial paper, that should not have defaulted any bank. That means what? They should have the loan which is based on the that should be under the standard category. right? So the loan they are having, that must be fund based facility, means the loan they are having that must be into the standard category. That should not be the NPA. That's what the criteria. And they should have the 100 crore worth if they are the cooperative society, union, trust, LLP. Otherwise, the company in NBFC or all India financial institution, they can issue the commercial paper. Okay, see further. Following are the eligible investor who can purchase the CP. Okay, so all resident can do investment in the CP, but for a non-resident, they are also permitted to invest in the CP as per the provision in the FEMA Act, FEMA 1990, Foreign Exchange Management Act. Okay. No person can invest in the commercial paper which is issued by a related party in either in the primary or the secondary market. Okay, obviously related party issuance is not allowed. Now some other condition, for example, CP shall be issued in the form of promissory note only. It is the promissory unsecured money market instrument. It is always at a discount to face value and is always held in the demat form. Okay, now let's learn some fact about the commercial paper. See, minimum amount should be 5 lakh and then multiple of 5 lakh, which is same as the CD. Minimum period is 7 days to 1 year. Maximum is 1 year, minimum 7 days. No issuer shall have the issue of CP underwritten or co-accepted. Option that is called or option put option, these are also not permitted under the CP. Issue in the demat form, that should be in the promissory note form, in demat form as a promissory note, and that should be at a discount to face value. Then the issuer can't underwrite or co-accept, which here we have already discussed. No option permitted, either call option, put option, not required. These are not options are not permitted basically, neither the call nor the put. The minimum credit rating of a CP shall be A3 as per rating symbol and definition of the SEBI. So what should be the rating to issue the commercial paper? The rating, at least A3 should be the rating. In case of the issue of a CP for 1000 or above in the financial year by the entity, the rating should be obtained from 2 credit rating agency, right? That is what the lower rating only out of that will be applicable. Okay, if you are going to issue more than 1000, right, then the credit rating from 2 credit rating agency is required. So see friends, in case of issue of a commercial paper of 1000 crore and more, then only you should have the rating from 2 credit rating agency. Out of that, the lower rating will be applicable. Okay, 2000 here it is 1000 crore. Okay, it is 1000 crore. Then buyback of a CP. So buyback of CP is not permitted before the 30 days from the date of issue of the commercial paper. You cannot buy back within 30 days basically. Buyback means obviously you have to buy at a prevailing market rate. So why? Because we are purchasing at a for example, say you are purchasing at a discount. For example, the face value is 100, you have purchased it at 90 rupees and you want to buy back. So at what rate you will buy back? At the prevailing rate in the market. Suppose in the market the rate is 120, so at a 120 you will get, right? So this is what the buyback at a prevailing market price. End use means what? The purpose of issuing CP. So obviously the purpose, the company which is going to issue the commercial paper, that the money out of that should be used only for the building the current asset or to meet the operating expenses of the corporate. That is what the company should use it only for the operating expenses, not any for the non-current asset or non-liquid asset generally. Okay, so what is the end use? End use should be only for the in the form of current asset only, not in the non-current asset. That is what for temporary use, that the money should be used within 12 months. Okay, to meet the operating expenses only. This is all about the commercial paper. So friends, you can subscribe us on the YouTube, you can join our Telegram group Banker Zone CIB, and you can download the application from the Play Store Banker Zone CIB. This is available for the Android user. Thank you friends.